So we finished the week of dichotomy here this week. It was an interesting week of risk off and risk on. So I'm going to break down why some charts look like we're risk off and we're headed into some weakness as early as next week on the S&P 500. On the other hand, there's some signals that show how risk on we are, how this bullishness we've had on initially doesn't seem like we're as bullish as we are, but on the other hand, could lead us into some bullishness in the long term because of where some asset classes are and their performance levels over the past year. So interesting dichotomy, kind of a bipolar market. I'm going to break down those two poles in today's video and talk about how we trade the two different poles with our trade idea of the day. So let's go ahead and get started. Today is Friday, April the 24th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator. Actually, we'll start off here. You can see across all of these, the Dow, the NASDAQ, the Russell, they're all now getting that combination of dark green shading and a green line. That is a bullish pattern on the market forecast chart when you have both of those. Now, a little difference here is, we haven't had this issue for a long time. Well, actually, it was since the last time we were coming off of a lower low point that produced this pattern. See, in the last so many years, every time we produce this pattern, we've been coming off of higher low points. The last time we actually produced it was right here, where we came off of this low. And again, until we had fallen at the very, very end of that, even that would have been, an relatively equal high had we come off of that low point. We made that last little drop, and that pushed us down. That's the last time we came off of a low. Otherwise, you can see all the rest of these. Every time we form this dark green shading, and this the period in between, these periods in between, it was a higher low, higher low, higher low here, higher low. It would have been a slightly lower low there, and then a higher low, higher low, higher low, and now, boom. And now you can see this low point is below all of these lows. In fact, it goes all the way basically down to this low point was the last time we've had a low that preceded this pattern that's lower than where we're at right now. So, but nonetheless, it is a bullish pattern to see dark green shading and a green line. So definitely something to kind of keep an eye on in terms of, again, strong bullish pattern. Now, long-term sentiment still slowly rising at very low levels. So when, not necessarily out of the woods yet. The near-term line is jumping back up here, but it's not jumping back into the reversal zone yet. So, but nonetheless, this little bullish intermediate confirmation signal that we had yesterday has played out into a bullish bounce here today. If you look on the flip side, though, you can see the Russell 2000, which did not get that confirmation signal yesterday. It does not have an intermediate line up above 80 yet, and its market sentiment line is above 20 and rising, but just barely. And again, this is just barely giving us a pattern. In fact, it just started here today with the intermediate line turning up. Something else to kind of keep an eye on. Now that we're done with the weekly candle here, here's the weekly candle for the S&P 500. A little bit of a long lower shadow here, but you notice here we are not above. We don't have the dark green shading in the green line, which typically coincides with a beginning of a bullish move. In fact, the further out you go in time, you see how long these can last. I mean, this is weeks. These are all every one of these are weekly spots. You can see we had essentially from the beginning of 2016 all the way through to the October of 2018. I mean, that little brief period at the beginning of 18 just gave us the light pink shading and the yellow line. Same thing there briefly until we had that late selling. And then we had this pattern here that went on for about a year, a little bit less than a year before we finally came down. But you can see how long, before this period, the last time we had, dark pink shading and a red line was 2011, and we had a nice good run to the upside. If I go back out a little bit further here, you can see obviously there's brief period of time of dark pink shading and a red line in 2010. That gave us about a 1 year run to the upside. And then of course over here, this is kind of how we started out. We got up to light green shading and a yellow line, and instead of going through it like some of these others, right, all these other periods where we got light green shading and a yellow line, we went through that and just kept going up. Here we actually failed there and turned back over and kept the dark pink shading and red line, and that's what got us going to the downside. Very similar over here, right? We got light green shading, got a yellow line, and then we kept going down to the downside. Here we got light green shading and yellow line again in May of 2001 and kept going down. Over here you got some dark green shadings and briefly some green lines, but that didn't last very long. And we kept going down to that July, to where, to the lowest, to the worst selling that we had of that particular recession outside of 9/11. And then we finally got the dark green shading and the green line there. So you can see, when you get these runs where, that combination kind of comes together at once, then it's a little bit better. Even though here, like by March of 09, you can see we really took off. We were so far down in March of 09 that we rallied back up. We got the light green shading and yellow line. We went through it and stayed above it, and eventually it converted over. So here we're not to that point yet, right? I mean, is this gonna hold and turn us around like we did in this area? Well, if you were to even look back in 2018, early 2019, this is about the stage. You could argue that this right here where my cursor is the stage that we were at then. And we kept going up, and eventually we got up above it and got into a yellow line and stayed above it, even with a little bit of a pullback there. And that was a good time for a trend to the upside. We're not to that point yet. So can people say that we're really bullish going forward from here? Not necessarily. And of course, that's the S&P, which looks a lot better than the Russell 2000, where we're not even close, right? Not even close to that point of getting up to that 30-week moving average. So, we kind of might need to pump the brakes a little bit on how bullish we are. A couple of weeks of long lower shadows in a row for the Russell 2000. But just kind of, this, as you'll see here, in fact, let me show you right now. If I look at the RSI and CCI, you notice that the area between 50 and 60 on the RSI, that's the suckers area. That's the area where we're above 50, so it looks like we're really bullish, but we're not above 60 yet. So we haven't really established the trend and really gotten going to the upside. And that's on the daily chart. The weekly chart's not even above 50. So it kind of shows us that we're not really there. We're not really to the point yet where we're like, okay, now we're really bullish to the upside. The Ichimoku cloud for the S&P 500, you can see on SPY, we are kind of meddling around with the Ichimoku cloud. We're not through it yet, but we are kind of in it. But we're also, still in a very weak bullish trend. So we haven't really established even a moderately bullish, strong bullish trend, much less getting above 5 and above 80, where we kind of get established and get going on a strong trend to the upside. So, again, you go back to, 2018 at the very end here, 2019, we were weak for a while. We finally got through it, and we were well above the flat line there. We're not so above it now. But we finally got through, and then finally got above 5 and above 80, kind of in this level here, and we really got going. And we were able to stay above the trend, and we really got going there. So we're not quite there yet. We are, obviously, that we are well above where we were 26 days ago. So that's pretty bullish, and that's kind of a flip from where we just were, right? Just, a few days ago, about a week or so ago, we were still below where we were. So that's a nice positive flip on the S&P 500 to be that far above. And the Russell 2000 is in the same thing. It's only done it a couple days ago. See, a couple days we were below where we were at from 26 days ago on this day right here. But now 2 days later, or 3 days later, excuse me, we're well above. We're well above where we were 26 days ago. So, but still below the cloud, and not anywhere close, of having any kind of trend developing here. We're actually still on a weak bearish trend according to this chart. All right, before we go further into look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also a subscribe button down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video too. That tells us two things. Number one, you liked our video today. And number two, it tells us that you want us to do the video again on Monday. If that's the case, click that thumbs up icon. Do it right now. It's a quick way to give us feedback. You can do that right now. If that's not the case, then you don't have to click on anything. If you don't like our videos, that's the beauty, right? You don't have to click on anything there. You can also comment down below on anything that stood out to you. What questions or comments do you have about anything I talk about, or for that matter, anything I don't talk about that's kind of part of this discussion? You can post that in the comment section below. Follow me, or excuse me, join our website at marketscholars.com. There's a link popping up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog post here, I suggest or recommend that you check out some of the other stuff here on our site, including our Market Outlook live videos. We post these at 3:30 Eastern Time. These are for both our monthly and our premium subscribers. We also have all of our classes coming up here over here on the right. This link here takes you to where you can see more of them. Again, this is all of our monthly subscribers get access to all of our classes except for our 2 Q&A sessions. Mine is coming up tomorrow morning, kind of an online coaching session. Other posts that are here. Here is a link to the monthly subscription that you can test out. You can do it month to month and cancel any time. So if you want to check out our classes, there's an easy way to do that. Click on that link there. And then we also invite you to engage with us on social media. Click this heart. It opens up a new window, and like the Market Outlook tweet there. Click that thumbs up. Takes you to your Facebook account. You can like today's Market Outlook Facebook post. Again, the more you like our stuff, it benefits us because then those platforms will promote our content to all of our followers. And it also benefits you because the platforms will promote content to you based on the accounts that you engage with the most. We try to make it really easy for you to engage with us here. Going back to the charts now, looking at our weekly chart, you can see how the candle. This is an interesting little development. We barely closed. If you notice, last week's Heikin-Ashi candle, we closed at 28.14. This week's Heikin-Ashi candle, we closed at 28.19. So very positive development from that regard, because getting lower, it is barely though, and you can see getting higher closes is good for a trend. Getting lower closes, or even in this case, slightly higher closes is not necessarily, especially when you don't get higher highs, and we didn't get a higher high here. So we didn't get a higher high, we barely got a higher close. Not the most bullish sign here. And again, you look at next week's Heikin-Ashi candle, which will open up right around 27, 60, 68 in that area is where the next week's open will be. And we close at 28.36 was the actual close. So we're already going to be flirting with getting above this high here, but if we don't get above that high, if we come down below 28.36 or 27.68, excuse me, which is not very far down there, based on where we were this week, then we can start getting a kind of a reversal type pattern here. So that's something to keep an eye on next week as we're really shrinking up the ranges as we're heading into these long-term resistance levels. First, the 50-day moving average, and second, the upward trending long-term trend line. If you take a look here at the 3 green arrow chart, obviously we have 3 green arrows. You notice we still haven't got the MACD red arrow yet, but we are getting closer to it. And then, of course, when you look at the stochastic indicator, especially when you look at the 2-line version of it, and we talked about this. We talked about this quite a bit in the in my last Market Outlook video on Wednesday night. We talked about getting these bearish crossovers when you are below, when you're forming a lower high point, when you're not in the bullish trend, but you're in more of a bearish move here. So they're getting this bearish crossover and then a falling MACD histogram, which means we're close to a crossover there too, suggests we might be in the mode of, testing, at least coming down and testing the 30-day moving average, which is not surprising. When you cross above longer term moving averages, you tend to get some tests of those long term, whether it's 30, 50, 200-day, whatever. You tend to get some tests of these. Obviously, we haven't crossed above the 50 yet, and we're way below 200. So, but here's our first one, 30. We are above the 30, so we have the opportunity to test that and see if this trend change can actually hold or not. I also wanted to point, I pointed out the RSI and the CCI, and I pointed out the idea that that this kind of a sucker's range between 50 and 60, where you're not really too bullish yet, but you're not on a bullish trend. Well, you have something similar on the DMI, right? So on the DMI, the sucker's range is between 25 and 30. So when you're above 25, you're bullish, but you're not really strongly bullish. The trend's not really established till you're above 30. And then this is, of course, below 20. And we're obviously not to that point yet. We're still kind of stuck in that sucker's range. So, and that's SPY. If you look at the small cap index, we're not even close to even a bullish move here, where the positive gets above 25 at least, and the negative gets below 20. So, again, we're not there. We're not to the point where we're bullish, established bullish. Doesn't mean that we won't get there. It just means that if you think we are there, we're not. At least according to these technical indicators, we're not as bullish as maybe we think we are. Just remember, and we talked about this a lot in my technical analysis class today, that when you get these big wide moves, where the bandwidth really expands out. All we've done here is we still got a wide bandwidth. All we've done is we filled in space as we moved up to the top side. We can come down here and still just be filling in space because of how wide the band. So, of course, we can go up towards 300 and still just be filling in space and not necessarily be trending. So keep that in mind. And again, we talked about that a lot today. We looked at another way of forming these using Keltner channels in my technical analysis class. And again, remember, you get access to all of our recordings when you have that monthly subscription. So even if you just sign up for a month, you check us out, you get access to all of our recordings during that month. All of our recordings. I go back now a couple of years. So you can check out what we talked about today here over the weekend. But again, it's kind of an idea that shows that the only reason why we've gone up as much as we have is because we created so much space with how big of a bearish move we have. So keep that in mind in terms of, are we now back up the truck worthy here on this bullish move? All right, now let's take a look at the intraday move. And I also talked earlier in the week too about this wide band of the 4-week range. It's going to limit our upside, pushing this high tag up until this low tag comes up some more. But that's only, we got 1, 2, 3, 4. So, in the next week, it might be hard for this to move up. But within the next couple of weeks, then you're going to have, we get this moving off today. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So, in the next 2 weeks, we'll have it all. The last week's low point will be the 4-week range low, assuming we don't get a new lower low before then. So this will tighten up pretty quickly in the next couple of weeks. But until then, in the next couple of weeks, don't be surprised if we don't trade in the top half of this range as we kind of stall, producing this up, forming this high point up. As long as you don't stall too long. The problem is if we don't get a new high, even if we just kind of flirt with a slightly higher high and keep this high tag over, as I told you before, when the high tag and the low tag both get over here, which this would be the low tag, it'd be way over here by then. If the high tag ends up coming over there too, then that's not a good sign. Usually that's a bearish sign. That's enough of a contraction that we really kind of break out to the downside. As that's the Arun indicator when it gets up, when both lines get up or get really both lines get really high. Get really low, where they're both on this side of the range. that can be a pretty bearish sign. So we'll see if we can if we might flirt if to stay kind of bullish, to flirt with slightly higher highs, but not necessarily too high, because the bandwidth is already pretty stretched until we get this low tag coming up a lot higher. And again, that won't happen. I mean, the next week, I mean, it will still be here after the next week. So that gives us the next week to kind of watch for this area and look how easy it will be to kind of come into this 260 area, because there's very little volume below this point of control at 280. If we were to flirt or break that anytime next week, then a move down to 260 by the end of the week will definitely be within the realm of possibility, and still wouldn't be a new low tag, and actually would be the low tag within a couple of weeks. And then if that stays the high, then yeah, that would be pretty bear. I mean, that would suggest that we are now more in of a bearish trend that short-term trend at that point. All right, now let's take a look here at the range for today. Today's range, 5 points, no gap here to worry about. Like we closed yesterday 279.08. The low point today was 278.50, so no range. That didn't get filled in already. And then the volume at 85 million, very, very low. So, again, you look at what we're seeing here, the ATR and the price range, we're getting really close to that 3% where, that's that's not a low point, generally speaking. Getting below 1% is when we really got the bullish trend established. But getting to 3% is where we're low enough that now we start to bounce back up again. And we've seen that before when we've had ATRs break up in that 5-6% range. You can see, today's range very, very small. The volume at 85 million is way down here. I mean, that's pretty low for normal from where we were before. It's slightly above average right before this all started to happen. This is a pretty big, steep drop. In fact, if you notice on the volatility index, today we had a big, steep drop. We dropped for the first time down to the 95% mark after being right around the 100% all this whole time that we've been bullish until today. So keep an eye on that to see whether or not that ends up being a one-day breakdown and we pop right back up, or do we, stay down below 100%. So early next week, watch for a pop-up in the VIX. I expect that we'll get a pop-up back at 100, back up above 100. Now that we've had kind of a little bit of a breakdown on volatility, now we have an opportunity to actually bounce because we've gone down, we've gone low. Will remains to be seen if that actually happens or not. But that's an interesting pattern that we haven't gotten yet on volatility until today. So before we look at what's driving the price action, these different relationships, and our trade idea of the day, to summarize our technical outlook, or my technical outlook here, it's looking like next week might be the week we finally get some of this weakness that we've been looking for. I did tweet out earlier today, for those who follow me on Twitter, just because you expect, and I have been, and I still expect, that we'll pull back. How we'll retest those lows, I don't know if we'll go all the way down. And I've been pointing out that runaway gap on March 24th as most likely going to hold as a runaway gap. But we also talked about that gap from earlier, that we have a really good chance of filling, or from later, that we have a really good chance of filling that we haven't yet. And that could very well come next week or within the next couple of weeks, according to what we're seeing in a lot of different technical signs. So again, that doesn't mean that this bullish rally is all fake. It just means that we've had a good run. We filled in a lot of space, but we haven't broken out. We haven't established bullish trends, which means that we can easily fill in space to the downside and not necessarily erase all of this bullishness, but just fill in space, pull back through some of this. So, but even if that's the case, it doesn't mean that we aren't bullish. You'll see that with our trade idea of the day. You saw that with our trade ideas. We've had a few bullish trades over the past couple of weeks. So just because I expect pullbacks doesn't mean I can't make bullish trades. Just because I think that in the long term, in the intermediate term, we'll get some bullish moves over the next year or two, doesn't mean I can't make any bearish trades in the short term. And so, that's the idea behind markets is this is not a binary. You're not either all in on one side or the other, or you're all in you're all in cash, right? If you're expecting a pullback, you can make some short-term bearish trades on that. But it doesn't mean you can't have some longer term bullish trades with it to offset and balance off your deltas. And that's been a big part of what we've been doing for the last couple of weeks, a few weeks in our in my classes, especially in my directional option strategies class. That's that concept there. So once we figure out that we don't, if we're bullish or if we're bearish, that doesn't mean all of our trades are bullish or bearish. Then you see how traders actually can participate and not necessarily be, get blown up or start blaming people for their big losses because they're so one-sided. Soapbox, or get off my soapbox there. But that's our technical outlook. There's still bullishness here. Obviously, there's the bullish trend that's trying to get established, but I don't think we're there yet. And I think in the short term, and looks like as of next week or the next couple of weeks, we have the opportunity to finally get that weakness. How it looks like remains to be seen, but we have some gaps that we need to fill. And that might be the extent of the pullbacks that we get. So what do you think? Do you agree with that? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click that link to open up a poll. Hit either agree or disagree. If you click disagree, as always, comment down below as to why. All right, now let's take a look at what's driving the price action. Let's take a look at the major moves here this week that occurred here. You can see how we still have strong returns over the last 3 months in bonds and gold and in the dollar, the safety asset classes, and look at USO, and we all know the story that it had this week. Let's take a look at April here and take a look at what happened here this week alone. So USO had the big crash, right, down 40%. It finally settled down as the May contract got crushed and the June contract got crushed, and then we finally started to settle down after that with some rallies up to the upside. But you can see here, you can see how USO kind of throws off the scale. But this was a risk-off week. The stock market was down a little bit, not very much. You can see real estate stocks were down. Emerging markets were down less than IWM was actually up this week, which is kind of rare for that to happen. And then you can see too that you have your developed markets down here, and most of these were like gold and bonds were up pretty much all week long. And when you have gold and the dollar both going up together, that's not necessarily the most bullish of signs. It's not necessarily a bull market trend. You can see you have dark green shading in the green line on the dollar on the market forecast. You have a green line. You don't quite have a dark green shading because you pull back on the weekly chart on the dollar there, but it's still a bullish trend going on. Of course, you can see this is the weekly chart for gold. It's still strongly bullish. And then there's a daily chart for gold. It's still strongly bullish. So those are, that's a safe haven trade. Safe haven trade here. Bullish pattern on the daily chart. Bullish pattern on the weekly chart on long-term bonds. I mean, that's not bullish. Like, that doesn't represent a, bullish risk appetite. Yet when you look at the stock market, you think, man, what's over the last few weeks, this has been a really, really bullish run. In fact, if I go back to that asset class comparison and you go back to that 323 low point, so including the gap of 324, let's put that on there, and let's go to hourly chart here. I mean, there's your SPY doing really, really well, but IWM lagging behind. But you can also see bonds are up during that time. They didn't drop off, and they were really overbought, extremely overbought. They didn't drop off. Gold was also extremely overbought. It didn't drop off. In fact, if I were to go back here to 323 and go back just like a couple of years, like a 2-year chart, going into that low point on bonds and gold, you can see they're up pretty big. In fact, they were up really big going in, but they're up pretty big going into that low point. Stocks bounced off. They haven't dropped, right? Gold is actually up more. So now you go out further into where we are now, through the low point and then now the subsequent bounce up. Look, bonds or gold is up more than it was at the low point. Bonds are up higher than where they peaked. And you can see the dollar is up very strong still. None of those safe haven asset classes have come down even though in the last couple of years we've had all this volatility. And as I have always mentioned, the bear market and there's a big jump up in volatility actually started back in January 26th, and we have really, really good returns. And safety asset classes are up really high point, including the dollar, and the S&P is just barely getting to break even. After this, and you can see small cap stocks are still down 20% from that January 26 high, and of course USO is doing what it's doing. So we've been in the bear market. The safety trade is still overbought. It's that's a good sign. It's a good sign for stocks to be bullish when those are as overbought as they are, because they have to come down. They have to create some value if we're really going to be bearish over the long term. If I were to go and look at the same thing going into October of 2007, where we peaked there, and we'll come here October of 2005. 2 years going into that bear market for stocks, you can see gold was up pretty big going into the end of the year, but so were stocks. Stocks were doing really well and bonds were down. Then obviously things turned around as we got into May of 2008. That's when we failed at that moving average. Again, you can kind of see bonds started to rally at that point. Gold stayed strong, and again, it was hard for stocks to really get going through the 200-day moving average. Because gold was still really bullish. It needed to come down more for us to be able to sustain a move to the upside. So now you come to March, I believe 9th of 2009, and to kind of give you an idea, by the time you got to this February 8th, and we even had a rally into the end of March, but you can see there wasn't much of a move there anymore. It had stopped going up at that point. And all the stocks have fallen, but it had stopped going up. It wasn't nearly as bullish. We weren't at the end of a bullish run, kind of like we are right now. So we kind of need this gold pattern to stop going up. This is the 1 year chart for gold and bonds. I mean, it's not a bad thing. That's why I think, in the 1-2 year time frame, we can be really bullish. I'm a little concerned that QQQ hasn't pulled back more, but we can be really bullish as people get out of the safety trade, unwind the safety trade, and move back into risk asset classes that had been pretty bullish previously. I mean, look again from that 1 year time frame, we were down pretty decently in stocks. So there's opportunities for us to come up, and for this to come down. The question is when. I mean, have we already done it? And my thought is probably not yet, right? Probably not yet. But again, just because I might be bearish in the short term doesn't mean that I don't think in the next year or two that we might not be really bullish. It'd be ideal if we continue to consolidate in this area, that we'd get some more of these NASDAQ 100 companies consolidating more and creating more value so that they can go up more. Without our valuation ratios getting so extreme to the upside. Because as of right now, if we just keep going up from here without any kind of consolidation, especially in those stocks, if we keep going up for the next year or two, especially even just a year, then you'll see PE ratios over the next year just skyrocket, which that's not a sell signal, but it's definitely a return expectation signal. The higher those PE ratios get, the lower the return expectations are going forward from there. So something to keep an eye on. As always, you take a look at, how broad is this buying? Is it global, right? Are we getting all the other major economies kind of turning around and giving us the same thing? Are we getting green lines? Well, look, they're all just starting to give. Some of them aren't. Brazil's not, and Italy's still struggling, but everything else is just starting to roll over. So they're looking just like us. So this is kind of a nice little broad bounce off this oversold rally. Now the question is, will it sustain and turn into a longer move? Because we're in that suckers mode, that suckers rally mode. We need to break out of that sucker rally range to the upside for us to feel really good about a bullish trend going forward from here without more consolidation. Otherwise, the expectation is to get some more consolidation here. Now let's do the same thing on this from a U.S. sector standpoint, right? Because that's the next thing we always take a look at. And of course, they're all dark green shading and green lines rolling up too. You can see all of them showing that pattern. Of course, when you look at the weekly charts, not quite the same. And so, that's why we don't want to get necessarily suckered into thinking this is the start of this is the bullish run, without some consolidation. And a lot of times that might get a lot of people thinking. We talked before about getting people off the bandwagon of coming back down here. When the pain trade is to the downside, then that's when it will go down to the downside. So the more people get suckered into thinking, okay, this is it, here we go, and all that cash has been quote unquote waiting. Like I said, I tweeted about that earlier today, but if nobody's had any bullish trades going until the retest of the lows, and they've been in cash this whole time, as they start getting in cash, they will be a lot weaker hands than people who got in cash down here, right? Or got into some bullish trades, at least some bullish trades down here that have some gains in those, that are willing to let some of those gains come off as we pull back. Whereas people who get in just now as we start to pull back and retest or even fill in that gap, and that's the gap I'm talking about, this gap right here. That's the one I still expect us to fill in. So if we do pull back, that's the area of pullback, and you can see the same thing here and the same spot here. That's the area of where I expect it will pull back down to. And that will be painful for a lot of people who are just now going into cash here, if that ends up being the case. Otherwise, if people aren't getting into cash or getting into these bullish trades yet, then the pain trade's still going to be to the bullish side. And you'll be able to continue to ride what's been leading us up here, continue to lead us up to the upside. And of course, we all know what those sectors are, but especially they've been those strong sectors have been pretty good. Remember, this was a risk-off week, right, from an asset class standpoint. But if you look at the sector rotation for this week, all the way to April, and just look at the intraday for just this week alone, I mean, it's relatively risk-off, but look at what's rallying. Even though we're down on the week, communication services, technology, and discretionary with materials and energy all up above the S&P. But then, and again, utilities and real estate down below. So, I mean, that's a risk-on perspective. Even though we were down for the week, that's a risk-on rotation. So it kind of shows you what's leading the way. And if the pain trade keeps pushing us up because of people not getting in, then you'll have these leaders keep leading us up to the upside. But if these areas, industrials and financials, don't join the party, if they don't start getting above this black line like we said on Wednesday, then we know that, okay, this is just like we saw at the beginning of the year, where those mega cap names are leading us up, and at some point in time they can't lead us up anymore. And then whether we'll have a 34% drop in 4 weeks, or whether we'll have a 4 or 5% drop in a week or two, that's what happens when those few names can't keep leading us up anymore, and the rest of these cyclical areas don't join the party. All right, so for our trade idea of the day, again, being pretty selective on what we want to be bullish with. If we do keep moving up higher here and forcing those cash players back into the game, one of the trades I wanted to take a look at, or one of the stocks I've been looking at that's got its own little bullish pattern, is Marvell Technology. You can see good bullish move here on the daily chart. If you look at its weekly market forecast, unlike the market, which is still down here, it's got dark green shading and a green line on this weekly chart. So it kind of shows you a little bit of a difference. In fact, on its weekly moving averages, we're getting, again, higher highs, higher closes on the candles. We're getting a golden cross. So we have a really good trend. It's an outperformer in terms of how it's performing relative to the broad market as a whole. You have 3 green arrows, and you're getting some weakness, so don't be surprised if we don't pull back a little bit here, and I wouldn't be necessarily surprised. Again, you can see where the 17-day, that's the expectation. Any pullback, I expect that we'll at least test that 17-day first. That's up above where my stop order is right now. See when we put on the trade here in just a second. You take a look at its Bollinger Bands. It is close to breaking through the top end of its value area, very low volume up above where we're at right now. So good sign from that perspective. It's Ichimoku cloud. You are well above the cloud, and its trend strength indicators are up to those really high levels of extreme strength. The DMI, I mean, these are all things we'd like to see on the broad market as a whole, right? To suggest that we are now really bullish. We're above 25. We have already crossed through 30. We've had a little bit of a pullback here. As you'll see on a lot of the relative strength charts, Marvell has pulled back and is just now starting to turn back up in terms of relative strength. So on the pullback, we had already broken above 30. Now it's still above 25. We're still below 20 on the negative. So we still have the bullish pattern going here on its DMI. So bullish patterns all across the board. So that sets us up to buy at the money in this case. So unlike before where we bought out of the money because we had earnings coming up and different things like that, here I have the opportunity to be able to be more bullish because we have a lot of really good bullish patterns. So I'm going to go at the money, set my stop order at 50%, 50% stop order. So that gives me my risk in the worst case scenario is a normal position size. But if I get stopped out, I lose half of that, which is great. And then if we do go up a 1 standard deviation, then I at least get a 2-to-1 reward to risk ratio or more if we go up. If it goes up before August. And you notice I went out in August because, again, that sets me up for the opportunity shorter term bearish trades, but still maintain a bullish position if we keep going up, or if the pullback on the broad market is shorter and we roll right back up again off that 30-day moving average. So it sets me up for really good opportunities here on a stock itself that I'm pretty choosy with. It's got really good bullish patterns, kind of unique to itself. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen to go to our Market Outlook forums on our website. Open up any new thread with any questions or comments you have about today's video, and reply to anybody else's thread. And let's keep this conversation going over the weekend here. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. Have a great rest of your weekend, everybody, and we'll see you all on Monday.